Sandeep, hi there. Good morning. I guess today I'm going to start off by talking about Jio Financial Services making its D Street debut. And given the fact that it's going to be the second largest NBFC, the fact that it is going to provide services across the board in the financial services space, what exactly is your take?
The Jio Financial comes into a highly competitive space with established players, both on the banking side, which obvious, and the NBFC side. So I think it's not like a duopoly kind of industry of telecom, etc., which was very capex intensive, and they came in at a time when they could capture huge opportunities. So I think still they will be able to do well because the financial uh, inclusion still has to grow, and overall credit demand is overall India still continues to be a credit starved economy. But I think the value of the company is in terms of the market capitalization, not the business, because there is no business per se to speak of. So I think we'll have to give it time, and the discovered price was, as it is, much higher than what was being initially estimated. So near term upsides are very tough to see.
Just looking at some of the other stocks which are going to be in focus, of course, all eyes are going to be what really transpires and comes out of that listing. That said, Sandeep, what about the overall market? You know, fresh China concerns, some of the lending rates getting cut there, noises from US not all that okay. And for us as well, food inflation doesn't seem to be ebbing off. And now there is that export duty on onions as well. So after tomato, it seems like onion prices are going to skyrocket. Do you think the markets are going to stall here for a bit?
Yeah, markets have been stalled and they've been facing the headwinds, both global and domestic. Global have been more to do with the US dollar index rise as well as the bond yields moving up. And China concerns, like you rightly said. So they are cutting lending rates by 10 basis points, etc., is not going to move the needle much. So I think they are in there are some secular issues which will take many years to resolve, which is not necessarily bad for rest of the world as it keeps the overall inflation and the inflation dynamics in control as China demand remains subdued. India specific food inflation is something which we shouldn't build too much of concern around because I think it's more seasonal, and as we go into the winter, etc., all these vegetable prices as it is come down. But given the fact that markets have had a very sharp rally since March, not only in India, globally, so we are seeing some consolidation correction which could go on for a few more weeks before we set up pre the festival season for the start of possibly some new rallies.
Be the other stock which is going to be in focus. Let's just bring up that stock price up for you. Remember, they've acquired that additional 27.18% stake of the shares in Carrot Lane, and it's a sizable sum, 4,620 crore rupees. So they're going to increase the stake in the company from the earlier 71.1% to now 98.3%. And the transaction is going to get completed by October end, as we understand. A couple of brokerages as well which have come out with their notes on this particular stake buy, and CLSA, they maintain their outperform target price of 32.70 on Titan. They're saying that the move only highlights the focus of the company on building Carrot Lane as an integral component of its jewelry segment, and it's not going to have any material impact on their earnings, and they're looking to only enhance the reach via the Carrot Lane buy. Sandeep, wanted your thoughts on Titan because that's been a little bit of a struggle on the stock.
Yeah, near-term growth was subdued, and post results we saw some correction, but I think the stock has hardly corrected actually. And this buy is more of them buying their own company. So whatever valuation they want to buy at, there's no competitor as such. So there's no market price for this buy. So they must have done some independent valuation and bought it. I don't think we should read too much into it, but I think what markets also underappreciate is the growing challenge which the entire diamond market faces due to lab-grown diamonds and the value erosion which could happen. So I think most of the analysts have no idea of what's happening. And I think that could be a challenge for many of the jewelry companies in terms of their profitability going into the next 2-3 years.
Sandeep, not just the fundamentals of the power sector, but it's been attracting a lot of FII money as well, right? We saw GQG in Adani Power. You had a JSW Energy block as well. What are you making of the prospects of the power sector?
Yeah, the FI interest is from one fund only. So I think the second buy also was by that same fund. So like, I don't buy the power sector as such. The equipment suppliers or the people, ancillary companies, transmission towers, etc., all those companies I find to be better bets because the capex intensity in power is very high, and then it tends to get into political interference, free power issues, issues of getting money back from the distribution segment uh, periodically every few years. So it's tough for this segment, I believe, to generate sustainable wealth. And let's see how it goes. But I am not investing in this sector.
That's the view coming in.
Let's just take a look at what ITC as well has been up to in trade. And an interesting note as well coming in there. Just going to bring that up for you as well on your screens. And, Sandeep, wanted to get your thoughts in on ITC. With all the positive news flow around, the earnings being good, the hotel demerger, etc. But do you think from the current levels, the upside in the near term at least could get capped for ITC?
Yeah, the upside is limited because ITC has been a stark outperformer in the overall FMCG segment where the rest of the stocks have not done anything great. So there's been a significant re-rating upwards driven by improved performance of the FMCG business, sustainable performance in cigarettes, and good performance coming from hotels, paper segments, etc. But I think a large part of that is captured into the valuations, and the demerger of the hotel business also did not go as per what the investors thought it would. So I think that also created some sort of a little bit downside in the stock. Overall, it's fairly valued at this stage. Further growth triggers for ITC could come in terms of further improved profitability in the FMCG segment and progress on hotel demerger. It could take some time. So I would agree with you that near term the upside looks capped.
Okay, I'm just going to focus on the metal space here. And Sandeep, markets, I don't know why, but they tend to always get excited that China ke अच्छे दिन आने वाले हैं. And when that happens, metal stocks, they start rallying. And then markets realize that, that's a huge economy which is going to go under its own, it's going under its own weight. The interest rate and growth dynamics are not favorable at all. What should one do with metal stocks in general when the China star trade has got diluted and the dollar index has started moving higher? Are metals an avoid?
Yeah, metals are completely an avoid. So metals, chemicals, specialty chemicals. So I think there are several segments which are very fancied by traders and short-term investors and a set of people. These are complete avoids. I think because prices are not going to move up. In fact, metals, we've still seen a correction, and stocks will actually remain more stable rather than fall too much. But all these specialty chemical segment, I think there we could still see much sharper corrections because the margins are going to fall very, very drastically out there.
Sandeep, what will happen to NBFCs? I mean, interest rates are not going to come down in a hurry. And typically, when interest rates do not come down in a hurry and inflation remains elevated, wholesale borrowing cost will not come down. The 10-year yields have already gone higher. Do you think after months and months of outperformance, NBFCs could underperform and time to switch out of NBFCs?
A near-term underperformance could be a reality given the fact that, like you rightly said, that margins get squeezed when wholesale borrowing costs remain higher for a longer time as more and more of the liabilities get repriced. So I think that's a phenomena which could continue in the near term. They still have growth potential now. The challenge for them and what investors need to watch out will be NPA trends and whether there is any deterioration in that. So if that doesn't happen, I think after some time these stocks could again start performing, and to that extent, some of the better NBFCs could become a buy. And so I think that's the important parameter I would watch out for.
Sandeep,
Yeah.
which is the Humpty Dumpty group in this market according to you? I know Swan is big, you don't remember Humpty Dumpty now, but yes, Humpty Dumpty does happen in the market.
So I think the avoid spaces clearly are like what we already discussed, the metals as well as chemicals, specialty chemicals. So all these spaces are the avoids. And X of that, I think we'll see somewhat more correction in many of the other sectors. But so I expect markets to remain weak or sideways for some time, but I don't expect a big crash coming in. So that's my overall view.
Couple of other names which are going to be in focus as well. And, we've been talking about what's really transpiring with inflation. And I think one key stock, or rather one key segment, is going to be all these commodity consumer companies. I mean, look at Mrs. Bector, for instance. We were just stacking up as to how Mrs. Bector has been one of the most stupendous performers of this year, perhaps, be it the one-year return or, for that matter, the one-month return as well on Mrs. Bector. I'm just going to dig out that data up for you and show you how these stocks have actually performed, because it's been, a great performance. 1 month return of 27%, 3 month of 63%, and 1 year return of 198%. But Sandeep, what happens to some of these agri-consumers now with wheat prices at a 6-month high, all the concerns around tomato, onion prices, and what have you?
So I don't think they consume tomato, onion, and all, but wheat and other inputs obviously will impact them. So this is a company I've been tracking for some time, like attending on call, etc. And I like what they have done, but unfortunately the stock has not given any entry, so it's not corrected at all. So I think it's a company which has done very well. Near term now the valuations are very high, so the concern is valuation issues rather than overall what they've been doing as a strategy. And if the spike in input prices creates a decent even enough correction, then we could look at buying into it at some stage.
Just get in your thoughts as well as to what the outlook is when it comes to the defense space, given the kind of opportunities that the sector is going to harness with the government's thrust on this space. Is there still more leg room for upside within defense? Are you being selective here?
So defense, we have to be selective because of the fact that the stocks have run up a lot, and like what Nuresh was discussing about, the most over talked of sector in the near term, that's defense and defense related stocks. So I think when markets enter into a weak range, some of these stocks could also end up giving up decent gains. So I think we should be careful near term overall, and try to look for better entry opportunities instead of buying at 52-week highs or all-time highs.
Okay, Sandeep, great to have you on the show. We'll let you go on that note. You have a good day.